What up, D Maj? Give me a little feedback on the mic to see if it's doing pretty well. We're gonna do some technicals first, looking at S&P, and then we're gonna go to Tesla really quick. The bulls are back, so we got D Maj. The bulls are back and stronger than ever. That's what we're gonna find out here. Are the bulls actually back for Tesla? Do we see the bulls back, right? But first, before we get there, before we get to Tesla price action, right? Check out the bull trend. Um, let's take a look at the S&P, right? This is the overall index, and what we saw today was a reversal candle, huge reversal candle. The yesterday we had a nice move higher after into the Nvidia earnings, and today just very bearish candlestick. Okay, so this is very bearish, but we are pulling into that 438 support, right? 438 support. That was our support that we've been marking here. We're still pulling into that support. And I think really the market is just selling off going into tomorrow's Fed meeting, right? Going into Jackson Hole, going into the conference, the annual conference for the Fed. That's all we're seeing there. So yeah, S&P selling off. If we jump over to the Qs, right, technology, we're seeing the same thing, pulling right back into support. 360. I think 362 for the Qs is sort of where you want to be at. 362. We could keep gapping lower tomorrow after hours, but I think this is a big reversal candle, by the way, super bearish. It does indicate we should be back to 357 at some point, but we have a Fed meeting tomorrow. So regardless of the technicals, the catalysts are going to make the catalyst is going to be a bigger indication of price, right? Sort of what is the Fed expecting? Now jumping over to Tesla really quick. Let's do the Tesla technicals before we get into the Fed. What is the good news? What is the bad news going forward today? So if we just look at the trend of Tesla, right? Anchored VWAP, you're looking at volume weighted average from the lows, which is basically January when the bull trend started for Tesla. All right, and going back, we can see that we're still holding above VWAP. Now we slipped below VWAP a couple times. All right, let me zoom in there. We did slip below VWAP a couple times right here, going into the what is this Q? This was about Q2 earnings. No, this is Q4. Okay, Q4 earnings. We slipped below it, and then we recovered based off some other catalyst. The market was strong. And, either way, we're still there. Now, we could come back and retest this VWAP at 200 for Tesla, but I think the bulls are definitely going to step in at this point if the overall market can hold up. All right, so we're holding the anchored VWAP on Tesla. We're still holding the uptrend for Tesla, right? The uptrend is in place. If you're looking at a good risk reward, it's always going to be here, right? When you're looking at a good risk reward, it's typically going to be into the trend, right? And that's what we're looking at. We're looking at coming into the trend right now, and that's what it's sort of looking like. RSI. Okay, let's look at the oversold territory for Tesla. The couple times that we got oversold, we bounced, right? Every single time we got oversold, you bounced. Now the market was still in an uptrend. We are still in an uptrend for the overall market, so we could get this bounce. And tomorrow's really going to be the big day. And then going into the weekend, how you digest what Powell's going to say, right? Is it going to be a little more hawkish, a little more dovish? I think it's going to be more dovish than people expect. Of course, he's going to come out hawkish because inflation is still elevated, but you're listening for the dovish tones. And we know if we look at some of his last speeches, he's been more dovish than he has in the past. So that's the big difference. And welcome back, Dimaj. Anyways, haven't seen you for a while. Hope everything's going well. So yeah, Tesla's pulling back into that trend. So it did attempt, right? We did attempt to break the downtrend. We did get to 240. We actually gapped up in pre-market to 240. So let's dive a little deeper. Let's go to that 30-minute chart so we can see sort of what we're looking at here. So we did get above the downtrend for Tesla the other day, and then we came back down. We going into the Nvidia earnings, Tesla ripped higher. The whole market was up pretty much, and we got to 244 in after hours. We got to 240, which was the big level that I said, okay, this is the last resistance before the momentum comes in, and we sold off this morning. But this is an overall market trend right now, right? Tesla's still holding the uptrend, right? We're still holding the uptrend. And the question is, are we going to hold the 225 level? I think that's really the last level. If we drop below 225, then I think, right, it's going to be a false bounce at this point. And we could get a false bounce. Okay, we could get a false bounce. It's going to come down to the data. And so far, the data is actually really good. The economic data is good. The problem is that valuations from a interest rate perspective are pretty much capped, right? With interest rates this high, you pretty much cap the valuations. Now you need better earnings. And, GDP is actually being revised up, so we might get that. Anyway, so yeah, this is the Tesla technicals that we're looking at right now. Always you get a really good opportunity when it's pulling into double trend support, right? We broke the downtrend earlier in the year, and then now we're retesting that trend. We got some capitulation. You're oversold, right? You're oversold bounce, and you got the uptrend still in place, and it's going to come down to, we're still holding above the anchored VWAP. It's going to come down to, can the overall market digest some positivity from Powell's speech? Yeah, right? That's what we're kind of looking at here. Now, diving over, what are some positives that we're seeing in the economy versus the negatives? Let's start with the negatives first, right? Let's go ahead and start with the negatives. And I'm going to throw up here. It's always better to start off with the negatives. So Powell's speech is tomorrow. The big conference is tomorrow. That's what everybody's concerned about. And I'm going to throw up this chart, which is pretty much what QT is looking like, right? What is QT? What are we looking at here? So basically what's happening is, the money market fund money. Here in black, you have the outstanding reverse repo facility money. And I just inverted it. And what you're seeing is that cash has been leaving the system. And we did get a bounce in January. Look at this bounce here. We got a bounce in January, meaning money market fund or cash parked at the Fed started to leave the Fed and come back into the market. Maybe it was going to U.S. Treasuries, whatever it was supporting the market. The more money that goes into bonds and Treasuries, the more that the bond market is stabilized, the more that interest rates are stabilizing, right? Because you're getting money buying the bonds, therefore the interest rates come down or they start to stabilize. So we've been moving up there, right? And the S&P had a nice run, and now we're kind of peaking out. So this is a negative liquidity. This is tightening, QT, tightening of markets. That money is anticipating, if Powell is hawkish and if he signals that we're going to continue to hike rates, right? And there's three things. He's either going to say we're data dependent, which is neutral, which is my biggest guess. He remains data dependent. Number two, he gets super hawkish and he says we're going to hike. There's more evidence to hike. Market goes lower. This money market fund liquidity comes back into the money market funds. Because if he hikes rates, guess what? You're going to earn more on your cash at the Fed. You're going to earn more money, the interest that they hike. You're going to earn more on that if you park it in cash. So this will come down, and that means cash comes out of the market and goes back into the Fed, goes back into the money market funds, right? So we want to see for a bull market this to continue higher, meaning the cash is leaving. Number two, the Fed is selling assets, right? We already know about the Fed balance sheet. This is liquidity from the Fed, and as they sell assets, they're essentially removing cash from the system because banks are forced to buy those assets, whether they're mortgage-backed securities, whether they're U.S. Treasuries on the short end, on the long end. And from what I've seen, it's a little more nerdy. They're actually selling a lot more short end bonds, which is why short end rates have climbed so fast. So they're not really selling long dated bonds yet. That's not really happening. And there's some evidence for that because the 10 to 25 year bond yields or bonds are actually having a bounce. We'll get into that later. So I just want to show that the market is tight right now, and we did have a nice recovery for a while, right? Some of that cash was easing coming into the markets, and then now it's kind of stalled. So, markets front run. Markets want to look ahead and say, what is the Fed going to do? Can we psychologically, can we at least front run that? We're not going to wait till he makes his decision. So we're looking at this money market fund liquidity after the meeting, probably not till Monday, to see if it actually starts to bid back up or if it comes down depending on what he says. Okay. Number one. Now, second part of the bad news, which is actually kind of good news, bad news, depending on how you look at it. All right. This is the next chart. Now, what I want to signal here, or what I want you to think about is that, yes, the Fed is tightening the market, but we're at a point now where we're above. So this is basically what level, when you hear the Fed is in restrictive territory, this is how much higher interest rates are versus inflation. Okay, and we haven't had really tight policy for a while. we are actually this whole gray area charts are on YouTube is negative territory. So if you're in negative territory, inflation right below this line or below the zero bound. Actually, let me so you can see my mouse below the zero bound, right? That is when inflation is actually above the Fed funds rate. That means inflation can really wreck the economy or really cause havoc. But we're out of that zone now. So the Fed is now 2% restrictive, positively restrictive. So this is why I think if they go higher, they're basically gonna, they're basically gonna cause a recession maybe at some point in the future. It doesn't look like we're gonna get a recession now, but they are in restrictive territory, right? And what this means is you take the Fed funds rate at 5.5%, you minus, so level of restriction, this is basically the level of restriction. You take the Fed funds rate and you minus the PCE, which is their preferred inflation gauge year over year. The PCE is about 3% right now, and it might tick higher. It comes in August 31st. It's usually like the last week of the month. And it comes in August 31st, and we might actually see it tick a little higher because of gas prices, right? I don't know, maybe not. We'll see what it looks like. But it's not projected in August at least to really fall any further. Not till September, because we know oil prices are down. Before we get into that, let's just keep it here, right? So we're in restrictive territory. This is the most restricted we've been since, what, 2008, 2007? So the Fed is in deep restrictive territory, and this is not good news or bad news. This is basically, if it goes higher, it's bad news, right? If they keep hiking, bad news. If inflation comes in hotter than expected, which isn't for a couple of weeks, then this restriction will go actually down. So what we're trying to figure out is this enough? Is 2% restriction enough for the Fed to pause? I think it is. I think they will pause regardless of what they're saying, as long as oil stays low, as long as shelter rolls over. I think they do pause because their level of restrictions at 2%, it's the highest it's been for a while. Now, I could be wrong. I just think the probability is much higher that they actually pause, okay? So we're in restrictive territory. Now, let's jump over to the good news. And you could see this as good news, right? The level of restriction from the Fed. But let's go ahead and jump over to, we also had some, it wasn't like very negative, but I'm going to throw this chart out here. Is basically durable good orders, because right now is good news, bad news, is bad news, good news is really the question. And yeah, if you want to see more tests of technicals, go ahead and jump over. I see you, Dima Yush. I'll read your, what did you say? Looking at unemployment restrictions did nothing. Unemployment restrictions. Okay. Looking at unemployment restrictions. I think that's all I missed there. I'm bearish. Ain't no way we going up tomorrow. You could be bearish tomorrow. Yeah, we could be bearish tomorrow. The market is rigged if it goes up tomorrow. Well, that's funny. The market is rigged if it goes up. Okay, if it's rigged if it goes down, it's rigged if it goes up. Dimaj. Hey, appreciate it, Dimaj. Hi, bro. Hope you're doing well. I've been away holiday Spain. Nice. I went on holiday too for a couple of weeks. It wasn't really holiday, but I was wondering where you're at. Nice to see you back, bro. So today we got durable good orders, right? And they ticked lower. They've been going up for about 4 months in a row, and we ticked lower. So the question is this good or bad news? Well, there's two ways to look at it for the market. It's really tricky. It's not like you want a strong economy and that makes the market go higher. That's not actually true. What you want is that right now in the conditions we're looking at, you want the economy to stay cool. Okay, you want it to stay cool, not too hot, not too cold. And the reason that is if it gets too hot, you get inflation expectations climbing. You get the Fed hiking rates. This isn't in regards to the stock market. Therefore, if they hike more rates even higher, then you're removing or you're cutting valuations for stocks. Basically, the rate of interest goes up for them to fund their growth, right? But if growth collapses, then their earnings fall. Therefore, the PEs go lower. Therefore, their earnings are lower. So you want that cooling. You want it right in the middle, right? You don't want interest rates higher. You don't want growth lower. You want it right in the middle. You want a cooling of the economy. And this is where some stocks outperform others, right? If you have good pricing power, if you have good cash flow, if people love your brand, if they're going to keep spending, you're going to be okay. But if you're more of a risk asset and you don't have earnings yet, you're going to probably be in trouble in this type of environment unless the Fed cuts rates, unless bond yields start to come down. So either way, durable good orders come down. That signals that the manufacturing sector had a recovery, but it might be cooling now, right? So we'll see those PMIs come in the first week of September to see. And you really don't have a full-fledged global economic upcycle until the ISM PMI survey gets above 50. We are not there. Let me see. Tomorrow could be Black Friday. It could be. Powell speaks early tomorrow. It could be Black Friday, but Powell does speak early tomorrow. So we'll see how he comes off. Tomorrow could be, oh, you already said that. The Fed is done for this cycle. I expect rate cuts mid 2024. That sounds pretty fair. The Fed is done for the cycle. I think they're done also. And if they're not done, then they're going to go ahead and say, you know what, we'll go ahead and cause a slowdown in the recession. We'll cause a recession, or we'll get closer to recession. We'll teeter that level, and we'll do that to get inflation, at least core inflation, lower. But for the most part, I mean, I think they're done also. I think the best thing to do if they don't want the economy to roll over is to be done. It's not like you could just control these things. You got to have to really thread the needle. And we've seen Fed speak actually say, hey, we should probably pause here. Okay, so I think they pause. Now the good news. All right, now the good news is, talking about the economy anyways, okay, is that GDP forecast went higher again today. So this is Atlanta Fed GDP nowcast, which basically is a projection of GDP, right? Quarter over quarter, month over month, whatever. And it's been climbing significantly. Now it's at 5.9%. And this could be a reason why Powell stays hawkish, because if the economy keeps growing from a lot of the fiscal policy, infrastructure bills, right, CHIPS Act, Inflation Reduction Act, then they can keep rates higher for longer, which is why I think they're more so communicate that they're going to hold rates, not necessarily increase rates, but hold rates higher. I think that'll be the communication tomorrow. We hold rates higher. We're data dependent. So the GDP for the economy, that is good news for the economy. The economy is rebounding, right? You can see the economy is clearly starting to rebound, and those stocks, those equities, not really crypto, but those stocks that have pricing power, that have cash flow, that can demand consumer spend there, are going to benefit the most. Okay. Now the next bullish chart here, the good news. Okay. And this is where people really get confused, because you're having growth start to rise here. Okay. This is called Goldilocks. You get growth rise, you get inflation come down. A lot of people get stuck and confused. They get so pissed off when I say inflation's coming down. And they're like, no, it's not. Look at my eggs. Like, well, here's to capture the model of inflation. Inflation is when prices accelerate. Okay, disinflation is when the prices are still going up, but they're falling. The rate of change is falling. Deflation is when prices come down. Nobody is signaling complete deflation. We're not getting deflation. Some areas you are, but we're not getting deflation yet. That would mean inflation goes negative. We're not there yet, but we are getting disinflation. Okay, inflation peaked in July or June of 2022. Where it was at 9%, now we're at 3%. So it's disinflating. Yes, your prices are still going up for your items, for your services, they're still going up, but that is the nature of the fiat system. We print debt and you grow, there's going to be some level of inflation, but we're not in deflation. So positive news, GDP is growing. And at the same time, we're getting some disinflation, right? For most things, we're getting disinflation. I think a couple services are still inflating. There's a couple more services inflating, but most of the economy is in deflation. So you look 12 to 18 months out, and this is why I think the market remains in the bull market trend, right? We're not in deflation. You don't really want deflation yet. If they keep hiking rates, we could get there. And if the economy rolls over, we could get there. I really doubt it, because I think Joe Biden and whoever's in the White House is going to just pump more stimulus and spend government spending. But if you get deflation, earnings come down, we definitely fall. All right. So those are that's it. Now check this chart out. This is very interesting too. Global macro investor. So we're in disinflation. GDP is going higher. This is Goldilocks, right? Inflation's coming down. Inflation's coming down because we're getting disinflation. Okay, not deflation, disinflation. And then also, this is just history. So let's look at the history. You expect cuts in 2024. I'll get to your comments also. They will cause a recession. Let me get to those comments. But let me finish this. So this is the average trajectory, right, or the path of the stock market, the S&P 500, right, over the last 12 historical episodes of elevated CPI, right, when CPI spiked. So this is going back to 1950, and once you get the peak, which down here is the peak, right, this zero bound is when inflation has peaked. This is when inflation peaks. you still get the, you get to the inflation peak, but the market is still trying to digest whether it's done or not. Then you get that double bottom or whatever you want to call it, and then you start to climb. We're right in line with that trend. S&P pulls back, everybody thinks inflation's going higher, but typically the market bottoms out once inflation peaks, and it consolidates for a while, and then it just runs higher until the next, until policy turns or until we hit a peak in growth. So we're actually doing well. We're doing pretty good here. And just keep that in mind. So let me go to these comments. May I get an opportunity to work for you as a thumbnail designer? I guess so, possibly. I don't know. I mean, maybe you could send me an email. Next we have, let's see. They will definitely cause a recession if they go. Give me a second real quick. I drank way too much coffee. I'll be right back. Give me a second. All right, sorry about that. Small bladder alert. All right. So back to it. I'm going to throw the charts on also as we talk through this. So yeah, this is the path of the S&P 500 traditionally or historically after inflation bottoms, right? And this is still, I think people get confused or they still think there's some other risk. This is still the biggest risk to the market. And as this risk disappears every, month or it comes back, the market's going to react and it tries to look forward into what we're going to see next. So Dimiush, let's do quick recession and move on. Yeah, we could get a quick recession. We could, but you're not. Here's my problem with the quick recession thing. We're not going to get a quick recession because there's too much stimulus in the economy right now. You're getting way too much stimulus from the government, and you're getting a lot of interest income from dividends, from bonds, from cash now. So I just don't think the recession is going to come. Maybe in some areas, right? Not a full-scale global or U.S. recession. You might get it in some areas. I think you're going to get a decline. Definitely some stocks are going to suffer from that. Some companies, some sectors, some industries are going to have a recession. But the full-fledged stock market recession, I don't really see or I think that's actually going to happen here. So jumping back to the technicals. Let's see, where was I? Okay, yeah, we'll get back to the technicals here. So yeah, next comment. They'll definitely cause a recession if they do it again. I agree. It's tough to say, like I said, because I think they're hiking rates because they see that the economy is so strong. You see the GDP forecasts from the Fed are going higher. So stocks like Tesla, who have a lot of, have hardly any debt, a lot of revenue growth, a lot of projections, I think they continue to grind up because their growth can expand, right? Obviously, you want China not to fall into a deep depression. You want Europe to recover to some degree. But when it's all said and done with, once you get that collapse of that fall, you're going to get pricing power stocks come back, right? Who have pricing power, who can keep up with this, all right? They were aggressive while now they're passive. I think you're saying month over month is getting interesting due to Fed actions this time last year. Oh, you're talking, yeah, you're talking about the month on month, the base effects. Yeah, the base effects are in. So inflation is not going to drop like super fast, but it is definitely coming down. Now, going to the macro technicals, I always say the easiest way to look at the market. Actually, before we get there, let's talk about interest rates, right? So, short-term rates, right? Short-term rates are still high. This means that there was a lot of bond selling. This upside move is basically short-term bonds were sold off by the Fed. So that when you see the Fed's balance sheet sell off, or basically they're selling assets into the market, they're selling a lot of short-term bonds, and that pushes interest rates higher on the short end, right? 2 year, right? This is really the risk right now to the market, is that these bond rates, which are the interest rates to the market, continue to climb. This is interest rate risk, and what that does is it puts pressure on institutions who lend, your banking sector, your financial institutions. They hold treasuries and they lend based off the treasury rate. These are the benchmark rates to lending. And if these rates go higher, their collateral is basically falling. Therefore, they have risk of, they can't inject that much liquidity. This removes liquidity from the market. A lot of liquidity comes from lending, okay? It's probably the biggest part of liquidity is actually lending. Every dollar you put in the bank, they can lend out $10, right? 9 to 10 bucks. That's fractional reserve banking. But if their dollars are falling, they lend less. There's less liquidity in the market. So this is also putting a strain on liquidity and valuations. Not only is it removing liquidity, but the higher rates at the same time are tightening valuations, or your projection, the amount of interest a company has to pay to fund is higher. So that removes earnings also. So this is very negative for the market. You see the 2 year, you got the 5 year, you got the 10 year climbing, right? But the 10 years came off. So this is good news so far. It could be just grinding higher, right? We don't know. But the 10 year did come off yesterday, and that was the big push in the market. We had a big push higher in the market. Europe was weak. We saw consumer spending starting to slow down in some segments. Nike sold off a little bit. Foot Locker sold off. And a lot of the shrinkage or damaging of items in stores is causing a slowdown, right? And you got the student loan repayment, so yields started to ease. And these are bond traders who are basically saying if it's going higher, they're shorting the bond market. But if it's going, but if growth actually slows, which we don't really see that happening, you're going to buy bonds, all right? Now, we pointed out this is bullish divergence here for the bond market. We saw the, RSI was climbing while the price was declining, and you got that pop. So we did get the pop in the bond market. You got resistance at, this is long-term bonds. You got resistance at about 99,100, support at 92, okay? Do we know the path of this? No, we don't. But if bonds go up, yields come down. The more that these bonds start to get bid up, and you get downwards pressure by the Fed selling these bonds, right? But if there's more buyers coming in here and we get this continuous rise in U.S. Treasuries or bonds, another way of saying U.S. Treasuries is that interest rates come down and this eases the market, okay? So it is tricky though, because, do you want to buy bonds or do you want to own stocks, right? Now, what that's doing to the dollar is this is the bad news right here. This is bad news. The dollar is rising still. The dollar is now testing my trend. It is breaking out of the trend, and this is not good. The dollar breakout is always inversely correlated. I'm going to show you to always inversely correlated to risk assets in general. I'm going to pull this chart out here so you guys can see it. All right. Now, here's what it looks like. This is how the dollar, actually, I'm going to take myself off so we can see the whole thing. There you go. Let's look at this chart. So 103 is the big level. What are we at? We're at 104. We are at 104 right now. Okay. 103, I think, is a big level, and we're getting above that level. So when you do get risk on, right? So risk on, this is Bitcoin moving higher. This is Nasdaq moving higher. So Nasdaq, Bitcoin. And usually you get that secular move up as the dollar, comes risk off, or as the dollar rolls over. And that's because, there's a lot of reasons for it, but you're basically getting cash going into assets prices, right? It's better. You're better off if interest rates are low. If the Fed is injecting cash into the system, assets are going to go higher, asset appreciation, right? Now you stack cash, and this isn't what you do. This is just like an easy way of showing it. When the dollar starts to rise, and on a secular basis, maybe over a couple of years, maybe you're better off stacking cash, right? And I wish those interest rates would be up at that time, because then you can yield off your cash and then reinvest it when the dollar peaks, right? So that's sort of the cycle here. It's just like a way to look at the macro cycle. It isn't foolproof. It's just a model. And right now, what I'm saying is, we're at that 103 key level. We're testing that level. And if the dollar breaks above this, well, markets should go risk off again, right? We should go risk off, retest next support levels. But if we do roll over, if we do get the dollar back to the charts, if the dollar can find, get resist against this trend, then it's going to be risk on. And this, I think, really, it's going to come down to Powell's speech, right, tomorrow. So how does he come off? Is he going to say, is he going to be more dovish or hawkish? That's really the key here. There's not much else to think about. This is interest rate risk that we are getting. The dollar goes up when interest rate risk comes into the market, higher rates and falling bonds. Okay. Now the another positive here, right, is, and I'm saying, like, I think we get 2.9% CPI in September if oil can stay where it's at. We got the reverse head and shoulders in oil, right? But it's bouncing here at this level, at this 78 level. If we crack through it, inflation expectations come down, right? And the Fed can be a little more dovish. You should see Fed speakers become a little more dovish. That should give a boost to the market. You're going to be in more restrictive territory if this comes down on a month-over-month basis, right? So oil coming down, good news. But, who knows? It could go back to the highs. Either way, we're almost done with August. And it's looking like, look, we opened up at $80. So if we're flat, that's pretty much zero crude oil inflation. And I think that's going to be good for CPI. How's end phase looking? Are we headed lower? Let's take a look at end phase. We will take a look at end phase. I just wanted to top off. Okay, natural gas is low. Copper pulling back. Wheat is still low. So there's no commodity inflation. Put to call ratio is coming down. The VIX. Hey, here's another negative. The VIX trend. This is the volatility of the VIX. It's starting to pick up. Okay, it's starting to pick up a little bit. So that's a risk off signal there for the VIX. There's more volatility coming into the market. Maybe it ends after the Fed meeting or after CPI expectations come back down, but you see that volatility starting to rise for the VIX. Credit spreads also, or equity credit, equity debt, it is climbing also. So that's another negative signal, and I think this is all due to the bond market going higher. So ENPH, ENPH and a lot of these other companies, I think they're going to be fine. Oh, it looks pretty nasty. Yeah, this is one of the biggest sell-offs I've seen in a stock this size. It's likely, I think there's going to be a bit into the future at some point, and I know it's like, oh, I'm down on it because of the Inflation Reduction Act and the CHIPS Act, all that stuff. You're going to get government spending into renewable energy. And so, that could have been the buy the news, sell the facts, but it's down 64%. And typically when this cycles back up, right, as big as it is, and I'm not an expert on in-phase technical or in-phase fundamentals, but in-phase should be, it looks like it's going lower, to be honest. It looks like it's going lower. You have a lot of support here, though, on in-phase. Let's check that support. Got a lot of support on in-phase. Let's see, you're looking at 100. Yeah, somewhere between 95 and, man, this is a real pain trade. 95 and like 125. I'd even say 120. So you have a lot of pain for the people who are holding. Never got back above that level. Got that double top rejection and big move lower. A lot of assets are selling off, right? Because the expectation for CPI is that it goes higher. So if we go to the PCE, like PCE, this is the Fed's preferred inflation gauge. It is down. But if we go to the inflation rate, that's not the inflation rate. If we go to the inflation rate, which if this stays in line, yeah, stocks are going to go. You see that bump from 3 to 3.2. The next meeting, the Fed is expecting, or some projections are at 3.4. So the consensus is not out yet. But if inflation consensus and expectations are up from 3.2, the market should continue to weaken because it's like, all right, maybe inflation's coming back. But I think if oil really comes down, you're going to get 2.9, and that's going to be a very positive read on inflation. Okay, that's going to be a very positive expectation. And remember, the higher the expectations for inflation, almost the better, because the higher the expectation, the more that the market might be positioned off, right? Underweight. And the higher that expectation, the lower it comes off. If you have too low expectations, then it's going to be harder to beat those expectations. A lot of it is expectations, positioning, and psychology, right? So yeah, getting back to this chart. I hope that makes sense. Dimaj, I think we got some comments here. What chart are we looking at? These charts are on YouTube, just so you know. Thank you, Jay. Nah, no problem. Dimash, hope everything's going well. All right, I still think Tesla looks pretty good. This was a nasty, you could call this a kill candle, though, on a higher low for the stock market. But it's not pure technicals because we have a Fed meeting tomorrow. So again, like I said, it comes down to Powell's speech, right? It comes down to a speech. We're headed into support. We have a couple more supports here, and we're still holding the uptrend, and it comes down to his actual speech. Is he more hawkish or is he more dovish? Okay, overall market sentiment. Now let's check in to see if we're going to check to see if any of the sectors actually were good today and even was green. Well, financials, they're turning negative as we speak. Okay, financials are turning negative as we speak, but they had a big move up in the morning, right? KRE actually bounced. Okay, that's positive. That's the regional banking sector, even though it's breaking the downtrend. Energy was up today. Okay, oil and gas was up today. Solar is down. So this is crushing ENPH also. TAN, solar ETF. Okay, this is just an ETF, exchange traded fund. And that was negative today. So a lot of those expectations might be that they're not funded. There's not enough stimulus. Rates are too high to support this type of growth. You need fossil fuels to sustain an economy right now. You can't just jump onto solar. But I think that will reverse when we get the full pause for Powell at some point. All right. Clean energy, same thing. Clean energy going lower. XLK, big downside. That was a big candle for tech. How big is this volume? Okay, not monster volume. So that's another thing to keep in mind. Yes, it was a big candle, but the volume isn't extravagant. So it's not like you have large volume selling here. It's just mostly buyers are waiting. There's a big move in Nvidia. Everybody got excited, right? They jumped into SMH, and I literally said yesterday, you better wait for the pullback because you don't know what can happen. We could get the sell-off into Jackson Hole meeting, and I think that's what we're getting, the sell-off into Jackson Hole meeting. So you got that gap up at the exact resistance that I said. The next resistance was 156 for SMH, right? The semiconductor ETF. So we got that resistance. Okay, communications down also. XLI, industrials also down. We got, who is this? This is healthcare. Ooh, healthcare is making new lows on the week. So is biotech. No, biotech's making new lows, not on the week. Consumer discretionary, staples, defensive. Man, defensive looks very bearish right now also. Defensive stocks, retail selling off hard, right? And this is a good narrative. This is a very clear narrative, which is that retail struggling. The consumer, it looks like the consumer has a lot of credit card debt, and we're gonna get a quick, maybe couple 3-month cycle of paying off those credit cards, slowing the spending, going back to school, and vacations are over, so spending is gonna slow down. Plus, you have a lot of the inventory getting destroyed from what they like to call, what was the word for it? They're calling it like smash and grab, whatever. The smash and grab, you guys have seen it, right? You smash, you go into Walmart, you break stuff, you see it, you see it get recorded on Twitter, on Instagram, on Facebook, on YouTube. People are crashing stores. So I think that's hurting a lot of the margins, a lot of the inventory is going to zero. So you see the retail ETF responding to that, also responding to the overall market, just selling off in general. Utilities try to bounce here. Materials were positive, and there's a lot of building happening. Real estate actually had a bounce. Interestingly enough, ITB also had a bounce. So that's sort of your market breadth, how things are looking. If you take apart the industry, the S&P 500 industries, that's kind of what we're looking at here. Okay. All right. So taking a look into crypto or into Bitcoin, Bitcoin's holding that 25K level, still pretty solid. Solid there. It's all about the bond market, right, and the dollar. I'll leave it. I'm gonna leave it with that for just the technicals, right? It comes down to Powell's speech tomorrow, and the question is, are we tight enough? You know, we're at 2%. We are at 2%. We're in restrictive territory up to 2%. Can they remain that restrict? Are they going to hold the restriction? And really, he might say nothing. He might just say data dependent. As long as the market can restore some confidence, if he can restore some confidence in the market to say, hey, you know what, everything's actually looking pretty good, I think the market does well. I think the market is going to do well. I don't see Powell getting more hawkish here, and he needs to stabilize this bond market, right? We need a buyer to come in to buy these bonds, or else we might be in trouble. Okay. Also, equity credit is still on the uptrend. It did fall off for a bit, but it still looks like it's on the uptrend. And we're at a shaky point, so we don't know yet. But we're on an uptrend in general. When it does roll over, then we can address that as an issue. All right. So, Dow. I forgot about Dow. Dow is testing the uptrend also. Actually, I want to switch charts. I'm going to switch over to the trading charts, so you can see a little more detail on the technicals when it comes to Tesla. Okay, so I'm going to bring this down. We don't really need RSI. S&P, let's see if we get that bounce at the end of the day. What do we got? We got about 8 minutes left, right? S&P is coming down. It already dropped 438. A lot of weakness. This is a simple sell-off into a Fed meeting, right? Anticipating the worst possible news. That's what we're seeing here. S&P down, what, 1%? Oops, wrong chart. S&P down 1%. So we're seeing that. We're just seeing a sell-off. I really doubt that this just accelerates until, after Jerome Powell speaks. But if you look, we're really coming into that 438 level, or this zone of support. Okay, we got excited, we moved higher, and we're pulling back into the zone of report to make sure that, not to make sure, but like, hey, are there bulls here? Are we going to get some bulls who step in at this zone? So this is the zone. If we drop this zone, then we're going to be in trouble, right? Below 436.50, I mean, it looks like we're headed for 431, which makes sense. We could be coming into the big support zone, 431. You want to take a look at that zone, what it looks like? Well, it's you got to go back to the 4-hour chart, I believe, and that 431 zone. And I know this looks like a big head and shoulders. It is. If we can't hold this trend, then we're in trouble. But we've seen the head and shoulders before, right? Just because there's a pattern doesn't mean it breaks out. There's wedges all the time that break down, right? There's bull wedges that break down. So, yeah, you do have the head and shoulders forming, and there's a lot of ways to look at it. But we got to see what Powell says. We got to see how the market responds to that. Right now, I would say we're leaning more towards weakness over the next couple weeks. I would say we're looking very weak until, as long as oil stays low, I think we're in good shape here, right? As long as bond yields ease, we're in good shape here. What's gonna have bond yields ease? It's gonna be Powell speak, right? What does he say going forward? Or, optimistically, the other part is if we get more weakness in the economy, okay? If we get more weakness, surprisingly, that's actually good for interest rates. So if we do see more weakness, right? And what data do we have coming up? Let's look at some of the data here. I'm going to keep it on actually, let me not do that. Let's look at QQQ really quick. We looked at S&P. Okay, so Qs are coming in. Like, Qs still have some more support. 358 was that last level. So I think the Qs have a little more support here, especially with NVIDIA. What did NVIDIA do? NVIDIA pulled right back into yesterday's close or open. Yeah, yesterday's close. So NVIDIA isn't like super negative yet. What about Apple? Right? Has Apple drop support also? NVIDIA still on that uptrend. APL. Okay, Apple's still holding the support, right? So we're just retesting support right now. That's what markets are doing, retesting support into the Fed meeting. Tesla too. You got the double top on Tesla, but it is breaking that downtrend. So we'll see if we can hold 225 is what I have as the major support. for Tesla to break out is 225. We need to hold 225, get a bounce off that, and then we can continue this uptrend for Tesla, holding the 100 daily moving average. Okay, let's go into the price action for intraday price action. So yeah, we couldn't even hold above VWAP. Market is pretty weak. It's all going to come down to how does the market digest Powell's meeting tomorrow. And like I said, I think the market is just pricing in the worst possible speech at the moment. It could go lower, but it is pricing in the worst possible speech. All right, now looking forward, right? What data could be weak that actually pulls down? Because you got to understand that markets are struggling because bond yields are elevated, so valuations are weakening because of this. So if we get weaker data going forward, that's going to help bond yields come down. So what we do have after Powell's speech, next week we have, after Powell's speech, right? This is just looking a little more forward. We have Dallas Manufacturing Index. That was super negative. It was at negative. Man, that's been negative for a while. So more negative. Home prices, Case-Shiller home prices, those have been so if these bounce, that's going to be bad, right? If these home price inflation, the rate of change or disinflation, we're in actual deflation when it comes to United States Case-Shiller home prices. We're in deflation. Prices are actually going negative here, okay? And these are prices. What this tracks, the Case-Shiller home price index, what comes in next week, residential house prices in the top 20 metropolitan regions of the U.S. So Atlanta, Boston, Charlotte, Chicago, Cleveland, Dallas, Denver, Detroit, Las Vegas, etc., right? Miami, Tampa. If you conglomerate all of them, you look at them as a basket, those prices are actually going negative. So if you get a positive pop there, housing market's a little too tight, we're in trouble. JOLTS job openings, right? This is Tuesday. There's nothing on Monday. It's all going to be technicals. But Tuesday of next week, August 29th, you not only get August 29th, what was it that we get on the 29th? I knew it was something important. I can't remember what it was. Anyways, we get job openings. That's a big one because the Fed continuously talks about keeping the labor market tight, right? Keeping it tight or loosening the labor market, or I'm sorry, tightening the labor market. Dang, I can't even talk right now. So if we get job openings, falling, that's going to loosen the jobs market. That's going to help the Fed out a little bit. So you want the jobs, you want the JOLTS to keep falling to some degree, right? And you want people to come into the labor force. So we're going to keep our eye on that. Job openings, job quits. You got more Fed. So probably job openings is your biggest catalyst other than some type of global economic, turnover in Europe. And then you have obviously 30-year mortgages. Okay, we get job numbers next week. This is going to be big. It's all about jobs next week. After, tomorrow's Friday. So from here on, all we're looking forward to is what does Powell say? And then what do the jobs look like next week? Can that ease rates? Can we get an easing on rates, right? Can we get the short sellers to stop out of their position and buy back bonds, get bonds up, get rates down? Can we get that? Wholesale GDP, we get some GDP stuff. Pending home sales, more home sales. And then we have personal spending and income. So we're going to get jobs in the consumer next week. That's what it's looking like. And so far, the GDP keeps getting revised up. So that's going to be interesting to see how that plays out. I think this is it. I think this is what we're looking at going forward, right? The technicals, we're going to see tomorrow's speech. Obviously, I'm going to go through it and see what he says. I'll do some I'll track his language to see if there's anything surprising. But other than that, the market is just holding on, right? Trying to price that in. I'll go over some questions and then we'll cut it from here. I think the Fed keeps interest rates the same. Yeah, I think they just hold. I think they're just going to hold rates. Poppy trader. And that is the end of the market. Maybe you get the bounce going into the close, but that's what it's looking like. Again, Tesla technicals, right? We'll exit with the Tesla technicals again. But on this chart, this does come down to the overall market, but it is a very nice signal, overbought signal, oversold signal, right? You only get a couple of these throughout a cycle, throughout a quarter. So we're getting that signal there. The RSI got oversold and it's bouncing. So we could get some bullish divergence here if you get the RSI continuing to climb and you see Tesla's price just stay sideways or even move lower, that's going to be bullish divergence. And then it's going to come down to, can rates peak? Can rates peak so valuations go up? Can earnings go up going forward? We're still in the uptrend. What chart is this? Why does this look so sloppy here? Oh, let's switch it to a macro view, or the quarterly moving average. That'll work too. All right, so this is Tesla on the weekly. We're supporting the 2 week. The last 2 quarters of earnings. We bounced off that level. Last 2 quarter of earnings, we need to get above 240 for Tesla to break out. It needs to get it back above 240. And yeah, it's close. It could roll over again, but we need to get above 240. Strong demand at probably 200, but that's if the overall market can stay higher, which is going to depend on, can bond yields come down, which is going to depend on, is the Fed going to be hawkish? What's going to depend on is CPI better than expected, which is going to depend on where's oil headed, right? Which always comes back to the price of oil. So that's all I have for you guys. All right. And if you have any questions, throw them in there. If not, we'll digest the meeting tomorrow to see how things are looking. All right, that's it. We'll catch you guys tomorrow. I'll probably send out another video today. And we'll see you tomorrow. You guys stay blessed. Get your exercise. Get your... Hey, if you're shorting the market, you might get a little excited tomorrow, right? It looks like that we got the head and shoulders. So if you short... make sure you know where your levels at for SPY. If you want to short SPY, make sure you know where your levels are at. This is, I think the short would have been on today though. 444 is the big level to get short. It's going to be tricky. I don't really think you can trust any of this. You got to wait for probably Monday or the end of day tomorrow, or else it's gambling. So we'll see how things play out. Anyways, I'll catch you guys later. Stay blessed. No matter what, stay blessed. We'll see you tomorrow.